and welcome to the Motley Fool. I'm Sonia Rehill and with me is David Kuo, and we're here today to talk about how to avoid a dividend disaster. So David, what is this mistake that many investors are making?
Well, many private investors think that all you need to do if you're building a high yield portfolio is to go and pick the shares with the highest yield. I mean, they head for those shares with the highest yield, and unfortunately, quite often they will head for disaster because many of these companies could cut their dividends, in which case the expected dividend that you're getting from these companies could halve in value very, very quickly. So what you need to do is to go and look back at the track record of the company a little bit more closely and make sure that the company has been increasing its dividends at a consistent rate over the long term.
Okay, so what you're saying is that while chasing a high yield may seem like a good idea in the short term, in the long term it's not really the best solution for income investors, or the best strategy for that matter. So what can investors do?
Well, what you need to do is to look back at that track record of the company and make sure that it has consistently increased its dividends over the long term. And sometimes, even if the dividend yield is not particularly high now, because it has been increasing its dividend at a phenomenal rate, then of course that dividend yield after a few years could become very attractive.
Okay, you've been looking at some of these companies that have increased their dividend consistently over the last 10 years. What have you uncovered for us?
Well, I'll give you one company. It's called Admiral Group. Now, Admiral Group at the moment does have a very high yield, but when you look back at the track record of the company, it has been increasing its dividend at a rate of approximately 9% every year. Now, the reason why it has had or it has a very high yield at the moment is because the share price has fallen due to problems within the insurance industry. No problems with the company itself, but it's just problems within the insurance industry that has depressed the share price, and consequently the yield is around sort of 7.6% at the moment.
That's wonderful.
Yes, it is.
Okay, so your next company is a company that is surprisingly relatively recession-proof. Can you tell us about that, please?
That's right. A very good pun, Sonia. My next company is called Next. It is a high street retailer. It occupies the middle market on the high street. So it's neither top end nor bottom end, but it is that middle market, affordable clothing. Now, in the case of Next, its dividend yield at the moment is 3.2%, but it has been growing its dividend at a rate of 7% a year. And the reason why it is generating this cash is because it is very good at approaching its customers. It has a multi-channel platform. So you can either go to its stores, you can go online, you can go on the phone, or you can actually just have a look at its catalogs in order to make your purchases. And in the case of Next, what it recently said was online sales grew in double digits. Shop sales, on the other hand, only grew at 0.2%. So it knows how to approach its customers and to get those customers to start buying its goods.
Okay, can you tell us about your final dividend grower?
Okay, my final dividend grower will explain why it is so important to have a look at this dividend growth rate. Now, in the case of my final company is called Royal Dutch Shell. Most of us know this company because we may go to its petrol forecourts and fill up our cars. Now, in the case of Royal Dutch Shell, its dividend yield is 4.7%. Now, many high yield investors may sneer at 4.7%. They say, surely I want something a bit more. But what you find with Royal Dutch Shell is it has historically increased its dividend at a rate of 9% a year. So if you work this out, if the dividend yield is 4.7% now, and it increases its dividend at 9% a year, after 8 years, that dividend yield could be close on to 8 or 9%. And fortunately, the share price will follow that, which means that its dividend yield could be consistently around about 4.7%, but you're getting a lot more bangs for your buck.
That's more than double the rate of inflation.
It is more than double the rate of inflation. You're absolutely right, which is why many people do like consistent dividend payers like Royal Dutch Shell, including myself. I am a shareholder.
Wonderful. Thank you, David. So there you have it. 3 dividend growers to beat inflation. And just to recap, they are Admiral, ticker ADM, Next, NXT, and Royal Dutch Shell, RDSB. Thanks for watching.